welcome back to New Business 101. Today we're going to talk about reading your financials.
Yeah, as an introduction, my name is Jordan Kuhlengel. I'm a partner with Gaap Financials and Associates. Catherine Kruse is our client service manager. This is part 2 of our Business 101 series, which is just an introductory course for people starting a business or becoming an independent contractor, helping everyone start off on the right foot. This video will be posted to YouTube, so if you loved it so much you want to watch it again, show it to friends, you are able to find it on our company page.
Excellent. So we wanted to go ahead and get started again with why we're doing this series specifically. Why New Business 101?
Yeah, so we wanted to start this. We've seen lots of people start businesses just through the nature of our work. We see lots of missteps that are easily avoidable. And we thought that some short introductory lessons in terms of making decisions, ways to set up your business, how to view your financials could be very helpful to our new business owners. So we wanted to make that a resource available to everyone.
One of the, I think a unique perspective that I might have coming to the webinar is like, we do have a lot of clients who have a very specific talent, but perhaps a business background is not one of them. So I think we've had clients in the past trying to bridge, how do they go ahead and start a business that they've always wanted to start, while actually like being able to get it off the ground, like what are the fundamentals that they need to know. And it's not very easy to look up online, you know, like there's an overwhelming amount of resources. You don't know what's right, what isn't right. So we wanted to put this webinar together a little bit anecdotally too, based on our experience with working with new clients. Today, we'll be working with our fictional client, Very Good Jams. Again, just to give you a background, kind of where this person is coming from. She is an English major. So Catherine, the founder, is an English major, no business background whatsoever. She's looking to turn her passion project into a viable business, but she doesn't know, other than like how to make jam, which she's very good at. She has no idea where to start. So it's important to say some clients might be starting in a different place, you know, like you might have a little bit more knowledge of the subject. Some of these things might be a little bit more obvious, but the purpose of these webinars is to really give you that foundation in order to build the correct building blocks to get ahead.
Yeah, and I think for any of our, more established business owners that are maybe attending this webinar, I still think that there's some valuable things to learn here, especially in the financial viewing section, which is what we're covering today. I think that given the nature, once again, of our work, we see lots of these, and maybe we can bring some additional insight into some of the numbers you look at maybe on a daily basis, but don't necessarily have a full grasp of how to utilize them effectively.
All right.
So the first financial statement that we're going to cover today, and really the main one, is the balance sheet. We wanted to cover the balance sheet because a balance sheet can reflect the overall health of both a company and then also the quality of financial statements. So before I get into all that, let's talk about what a balance sheet is. A balance sheet represents a snapshot of your company's assets, liabilities, and equity in time. So it is not stretched out over a period of time representing what you did in 2021. It's simply stating, this is my assets as of this date.
Why can that be a helpful thing to start with? Like, why did you choose this report to begin the fundamentals of reading your financials?
I think whenever we initially developed this, beyond being very helpful in terms of making decisions for your business, as a third party who often prepares other businesses' tax returns, the first thing that I look at in order to see whether or not the financial statements are correct is the balance sheet. If I see cash that has a negative $400,000 balance, it's normally a pretty good indicator that I can't rely on these financial statements to prepare a tax return with. So because it so often was an indicator of maybe poor quality financials or even positive quality financials, it's where we wanted to start because it's kind of the litmus test for me as a CPA.
And what I like about it, as someone who doesn't know anything about financials, is how short it is.
That's right. So this is an example of a balance sheet. So as you can see, it's as of December 31st, 2,100.
The Jetsons time
The
period.
Jetsons time period. It's tried and true. I'm sure balance sheets will remain the exact same now as they do out till then. But you can see that it's divided into these different sections that we referenced earlier. So we have assets. Under that, you see things like cash, accounts receivable, inventory, investments. Then you have maybe not so current assets, things you're going to use long term, such as land, buildings, building improvements, equipment. You have intangible assets, which I won't get into intangible assets right now. We're just getting an introductory course into financials. And those I would say are a little bit more of a intermediate level.
Can you tell us what an asset is?
I can. An asset you can think of as something that's going to benefit your company. So whenever you look at these types of things, it's not necessary. It doesn't have to be something you can hold in your hand. So accounts receivable, I can't really hold an accounts receivable in my hand, but it's a promise to receive money, which is a financial benefit to me as a company. Inventory is something I can hold in my hand. Inventory represents something I have on hand that I can sell later. So it's difficult to directly define an asset, but the best way I can describe it is it's something that is a financial benefit to your company. Liabilities are something that is going to have to be paid by your company at some point. So under there, you're going to see things like credit cards, accounts payable, accrued expenses, deferred revenue, which once again, we won't get into that one, and then the classic loans. So if you are using a loan to buy something, you're eventually going to have to pay that back. You're indebted to someone else. It's a promise to pay something. So it is a liability of your company. It's something you're going to have cash outflows normally in order to recoup. The last section is called shareholders equity. You can think of equity as either money you've put into the company, money you've taken out of the company, or income that the company has earned over the course of its historical operations.
Great. So Jordan did go ahead and put together a balance sheet for Very Good Jams, my jam company that we're talking about today. And I thought we could just go through it line by line. You can still see assets, liabilities, and equity are there. Obviously, he adapted it to be part of the jam company, but would you say like this is a fairly standard balance sheet just across the board?
I would say it's fairly standard. If you look, there's no specific assets, liabilities, or equity items that pertain specifically to a production of jams. There are things that obviously you use in the business, but they can be categorized into maybe generic categories across the board. We could make it more customizable if that was helpful to you as a business owner, but we did not for now.
Great. I thought we could just walk through this kind of line by line and talk about what some of these line items are.
I'd love to. So the first item is cash. Normally your cash is going to represent your bank account. So if you had multiple bank accounts, you might see multiple current assets representing that. In this case, we only have one, so we use a generic terminology called cash. Cash is not necessarily representative of the cash balance today, or even the cash balance as of, in this case, May 31st, 2022. What it represents is your bank balance plus any outstanding deposits, less any outstanding checks that haven't been cashed yet. So just because I have a bank balance of $50,000 and my book balance is $1,500 doesn't necessarily mean it's wrong. It just means that there's some reconciling items. And it's important to know the difference between that, just because you need to know what your available funds are to write checks on. So if Catherine, in this example, only paid attention to the bank balance of $50,000 and didn't pay attention to the checks that she was writing, and then all of a sudden she wrote a check for $10,000 because she sees she has $50,000 in the bank, and they cash all the checks at once, all of a sudden she has a insufficient funds charge and she can't actually pay the balance.
I think that's a great point, because as someone who, like lives day to day, just looking at a bank balance, like pulling up your phone app and being like, okay, I either have money or I don't. It's really helpful to know that like there's a lot more that goes into that specific number than do you have money or do you not. Like you have to think through all of the transactions that you're probably making, when are they going to hit the bank account, et cetera. And that's kind of the beauty of making sure your financials are up to date because they're gonna reflect that bank balance before you even have it.
Yep. Next, if we look under the current asset section, we have an investment account, Edward Jones account, made up number. This is just maybe Catherine had additional cash from loan proceeds or money she put into the company, or just cash that she's generated from operations. She doesn't necessarily want to just keep it in a checking account because she wants to earn interest and dividends on it. That's an account you could set up, perfectly legal for your company to hold one. It's not uncommon. And then as the account grows in value over time, you can update that as you go.
And this Edward Jones account is obviously referencing a specific account
Right.
with Edward Jones. Does the cash number, is it reflecting one specific bank account? Is it any bank accounts I have that are reflective of cash? Like what does that, how do you compare the two?
Normally, you're going to have separate line items for each different cash account, and maybe it's under a header of this is your cash.
Okay.
You don't normally combine them all because you want to be able to once again reconcile them and see each one separate balance.
Absolutely.
Yep.
Makes sense.
Accounts receivable represents if Catherine has provided jams to grocery stores, for example, and they bought them in bulk, and she is owed $3,500 of outstanding payments for products that she has delivered. That's what an accounts receivable is. There are other reports that you can run, which can be very helpful in terms of determining the quality of your customers or your cash flow positions, where you can run it's called an aged receivables report, which will then allow you to see how many days outstanding each of these invoices, these bills you sent out are.
And I think looking at this number specifically, it's important to emphasize we don't have that $3,500. It is owed to us, but we haven't, it's not the number reflecting how much jam like we've gotten cash for. It's literally $3,500 that we have billed for that has yet to come in.
Exactly. So if at the end, so let's say you've sold to a grocery store that all of a sudden, they're wiped out in a flood and the company ceases to exist. And let's say that you had $3,500 of receivables from, it's likely you'll never receive that money, right? So it's not indicative of cash you have in hand, like you said, and it's not a guarantee that you'll receive payment. It's a promise to receive payment. Normally, yes, they're going to be paid, hopefully within the terms that you set, but it's not a guarantee once again.
Excellent. You said aged receivables earlier. I think when you were talking about a report, what does that mean? What is an aged receivable?
So the normal way to run the reports and what I would say would probably apply well to your business is normally whenever you send a bill for your services, you'll give them a timeline that you would like them to pay in. So sometimes you want them to pay within 2 weeks. Sometimes it's a month, sometimes 2 months, 3 months, depending on, just the type of transaction. So if you have normal payment terms of 2 weeks, that would mean that you'd expect to be paid pretty quickly. An aged receivable report will show what customers have outstanding receivables for which period. So if you have Kuhlengel grocery stores as one of your clients, and it has ordered $50,000 worth of good from you, and I've promised to pay it in 2 weeks based on your bills.
Right.
But every single one of my receivables shows 60 days past due. It may be time to either renegotiate maybe your interest terms. It may be time for you to also maybe reconsider having them as a customer.
Definitely. That makes a lot of sense. Let's talk about inventory. How is it like, so when I'm thinking about inventory, I'm thinking about the number of jam jars that I have in my patented jam cellar.
Yes.
You have a number there. Is that 1,500 jam jars? What does that mean?
1,500 represents the cost associated with whatever item you're going to sell. So if you have 100 jars of jam, but each of them cost you $15 a piece, you would have $1,500 in inventory on hand. So that inventory number can be calculated in one of two ways. One is the cost to actually produce the item, which is what you would have to get to eventually if you were going to grow your own strawberries and make your own jam. The other, which is easier to understand as an introductory lesson, is if you were to buy your jams from another reputable jam maker while you got yourself up and going, let's say Kuhlengel Farms.
Certainly.
You would let's say you bought $1,500 worth of jam, your cost, your inventory levels will be 1,500, assuming you don't sell any of that yet.
So this isn't the number that I'm going to sell the jam for. Like aged receivable is, this is how much money I'm going to receive for the jam. Inventory is, this is how much money I've sunk into making this jam.
Yep.
It doesn't take into consideration how much I'll be able to sell it for.
That's exactly correct. So let's make the numbers easier for my head. Let's say you have 1,500 jars of jam.
Okay.
And let's say you want to sell, let's say you end up selling half of it. So what you'll do is you'll declare revenue, and let's say you sell it for $2 per jar.
Okay.
So you're going to have $1,500 of revenue, and then you will have cost of goods sold. Your inventory will decrease by $750, half the value.
Okay,
Yep.
that makes sense. Let's talk about fixed assets.
Fixed assets are something that is not written off immediately, and it's not an immediate expense. It's done over the course of time. Different types of assets have different useful lives, is what it's called. So machinery and equipment has lots of moving parts, isn't going to last forever. So normal depreciable lives for machinery and equipment are 5 to 7 years. There's different ways to depreciate things, lots of different ways, in fact. The easiest way to think about it is Gaap, which is what banks like to see.
Okay.
Or if you have some sort of, maybe if you had to report to the FDA for some reason about the profitability of the company, it would be likely that they would ask for what's called Gaap Financials, generally accepted accounting principles. So normally those will be written off evenly every year until the asset has written off its entire value. Other considerations are tax, which tax, normally people write off the entirety of an asset if it's allowed, because that decreases your taxable income. It's not always beneficial. Always consult your tax advisor before doing that, but that is the other option.
How do you make that decision? Like, again, just from my perspective as a young jam maker,
Right.
how do you make the decision between what you should write off and what you should be sure to be keeping an equipment list for?
The normal rule of thumb is if it's going to last more than a year and cost more than $1,000, you should consider capitalizing it.
Excellent. And am I the one who's going to figure out depreciation? Am I the one like who should be keeping this list of assets to be giving to you? How does that typically work with an accounting firm?
So normally what will happen is you as a business owner will do your best to put together a fixed asset list. And I, as a tax preparer or tax reviewer, will look through certain key accounts, whether that be repairs and maintenance, supplies, to see if there's any large expenditures in there that maybe should be capitalized. So it is your responsibility. However, there's normally someone to help you on the back end to catch any mistakes you may have made. And then in terms of whether or not you write it off in its entirety and the useful life, I would say it's pretty standard to rely on your CPA for that.
That makes sense. So how will the accumulated depreciation number change after a couple of years? Will it always just be zero? What does that mean?
That's a good question. So accumulated depreciation, each year you'll write off a piece of that equipment. So let's use straight line just because it's easy. So let's say it's machinery and equipment. It has a useful life of 7 years. That means every single year you'll write off $5,000 worth of that machinery and equipment.
Okay.
So since you just purchased it essentially today in this example, we haven't written any of it off yet.
Right.
But let's say next year, whenever it's time to update your books, you should see about $5,000 of accumulated depreciation in that account.
Excellent. And that is helpful to me. How?
It can be an indicator of the age of your equipment, so that you would need to know, in case you need to know when large capital expenditures may be required in order to keep your business operating.
Excellent. Okay.
It's not necessarily the absolute, this is what's going to happen. Machines don't just quit at year 7 on the mark. Sometimes they break earlier, sometimes they break later.
But it does give you kind of an idea of how long you've had it and like the relative value of the machine.
It also does not indicate the relative value either.
Does it?
It does not. So it indicates the purchase price less whatever value has been provided to it for depreciation. I would say the reality of depreciation is that in Gaap Financials, it's not actually relied upon very heavily.
Mhm.
And I would say most people look at it in terms of writing things off quickly and bonus depreciating them. There are instances where you don't want to do that, but still most people don't look at it in terms of an expense because it's a cashless expense. So
Okay.
it's something that's a little bit hard to account for as a business owner. It can be an indicator of things, but also, a truck 5 years ago was certainly that was a used truck is certainly not worth what a used truck is today, just because of economic circumstance.
Definitely. That is very helpful. What about land?
Land is a non-depreciable asset, whether it's GAAP tax, whatever. So if you purchase land, you're not going to be writing off that value over the course of time. There are certain qualities of land that may be applicable that you might be able to write off. So things like irrigation systems that are installed, sometimes those can be written off, but general rule of thumb, land not going to be written off.
So this number, I buy this land for $300,000. As long as I have it, this number is going to be exactly the same on this balance sheet.
Yep,
Doesn't change.
correct.
Interesting. Okay.
So liabilities are, once again, you can think of them as outstanding things you normally need to pay. There's some exceptions like deferred revenue, stuff like that, but the easiest way to
Sure.
think about it is things you're going to have to pay in the future. So in this example, you have a credit card, $1,300. So you're going to have to pay $1,300 at some point. Once again, that isn't necessarily representative of the bill.
Mhm.
It could be May 31st is the current period for these financials. Your credit card may end on June 6th. So this is just the amount that is outstanding as of May 31st.
Right now.
Right now. Well, not right now, back in May 31st.
As of May 31st, right?
Yeah.
A snapshot of May 31st, a day in the life.
Yes.
Excellent.
Accounts payable, similar to accounts receivable, just the opposite end. It's different than a credit card. Accounts payable are, let's say that Catherine has been buying her jams from Kuhlengel Farms,
Mhm.
and she has gotten 4 shipments of them, and I have sent her bills. $6,500 may represent the amount that she owes Kuhlengel Farms that needs to be paid within X number of days.
And again, just as accounts receivable is not money that I have, it's money that's owed to me. Accounts payable are not accounts that I have paid. They are accounts that I need to pay. I need to write Jordan's family farm a check for $6,500. And
That's
that's like
correct.
really helpful too, though, in terms of a snapshot in time, because we're looking at this and we know that we have that money, that we must pay it out at some point, and that it is like a real thing that we need to take care of.
That's right. So if I were looking at, one very helpful thing whenever you're looking at accounts payable, your credit cards, compare that to your current assets. So Catherine currently has cash of $1,500. She owes a Chase credit card for $1,300 and accounts payable of $6,500.
Eek.
It may be necessary that she either foregoes paying the full balance of the credit card or transferred some of the money from the investment account to her cash account so she can pay those bills. Whenever your current liabilities are starting to exceed your current assets,
Mhm.
it can be an indicator that maybe you need to take some course of action, not just run the business kind of on cruise control.
Mhm. Absolutely.
Other types of liabilities are more long-term liabilities. So the best way to think of that is loans for the equipment that you purchase. So in this case, you have machinery and equipment of $35,000. You didn't make any down payment on that machinery and equipment. So your current outstanding loan is $35,000 as of May 31st.
Great.
As you continue to pay those balances, that loan balance will decrease, not by the full payment amount because it's a loan. There's going to be interest, which will be an expense on another financial statement. But at the end of each payment, you should have the principal piece back down to where it represents your current outstanding balance of that loan.
Excellent.
The equity section, in this case, we have owner's contributions, distributions, current year net income, and retained earnings. So this is Catherine's first year of business. She's not going to have any retained earnings because she hasn't had a full year yet. If this year ended right now,
Mhm.
we would back down the current year net income into retained earnings, and then current year net income once again starts over.
Let's back up and say what retained earnings are and why we're starting with that in the equity account.
Sure. Retained earnings represent the totality of the income that you have produced as a company, less any distributions over the course of time. It's the value left remaining in the company.
So it's like I have sold 100 jars of jam and have made $100
Yes,
because each one was $1.
yes,
Retained earnings is $100.
no. If you sell 100 jars of jam and each one is $1 this year,
Mhm.
you're gonna have $100 for the current year net income.
Okay.
Whenever it's January 1st, 2023, your
Mhm.
retained earnings would be $100.
Okay, so it's like, thank you. So
Yes.
it's moving to the next year.
Yes,
So it's like on January 1st, which is what you just said, I'm pulling the December 31st number, starting there and kind of moving forward.
yes.
How does that play? I'm going to ask a question that I don't even know how to ask. How does that play into like my tax return? So like I send you, Jordan, my CPA, my books.
Mhm.
Does that mean like that $100 of my retained income goes on my tax return? Like how is that accounted for if it's sitting on my books?
Your retained earnings represent previous year's activities. So I will say that as I prepare the tax return, you have $100 of current year income.
Mhm.
The $100 of current year income is what you'll be paying taxes on April 15th of the following year.
Mhm.
And then different items then get put into retained earnings
Mhm.
after the end of the year.
How long does it go for? Is it just like forever? Like every single year it adds to my retained earnings? Is it just 1 year? Like what does it mean?
It's forever.
Fascinating.
It's forever. Yeah,
It's forever.
it's forever.
So I could look at that number and be like, my jam company has made $100 in the totality of its business.
Well, normally you'll back out distributions, but let's say you didn't in this case. Let's say you just had your retained earnings run forever. Yeah, it would give you the exact number that you have made over the course of the entire history of your business.
Awesome.
Once again, that's income, which isn't necessarily the cash increases and decreases.
Mhm.
There's non-cash items that can affect that, but we won't get into that.
Let's not complicate things. Very excited about that. Let's talk about owner contributions and distributions. Can you walk me through again, like what is owner contribution? Like what is that number?
So in this case, this is cash, or it can be property in certain cases, but most of the time you're going to see cash contributed to a business,
Mhm.
especially done in the start of a business in order for you to operate. So let's say you started a business today,
Mhm.
you would have to put money in to cover some sort of expense, whether it's paying your LLC registrations, whether it's buying your first jar. You have to put cash into a business normally, or at least get a loan in order to have some sort of operations.
The money has to have come from somewhere.
Right.
So in this case, I quit my full-time job, took all of my life savings of $9,500 and used it to start this new business. That was
Yes.
my money. I've now moved it over to the business so that I can run the business.
Yes.
How does that number play into like the other numbers we're looking at? Like, is $9,500 part of cash? Is it part of like the Jones account? Like, where is it in the balance sheet, if anywhere?
It could be anywhere. In this case, I would say it's most likely sitting in your cash in your Edward Jones investment account. But you could have an owner's contribution of $9,500, and you could have equipment valued at $20,000
Mhm.
and a loan of $10,500. So
Mhm.
it's always going to be offset with either a decrease in a liability or an increase in an asset,
Mhm.
but it can really be across the board anywhere in that financial statement.
That's great. And what's a distribution?
Sure. A distribution would be you taking cash out of your company, whether that be to pay yourself as a single member LLC,
Mhm.
or you taking out money just because you need it for a while, but even though you know you may give it back later.
I've decided I can't live off of my jam farm. I need to pay my electricity bill.
Right. If
my
you needed to
personal
pay your
one.
electricity bill, yes.
what if I took out a distribution of $9,500 because I feel like my cash is in a place where I can do that?
Mhm.
Does contributions go to zero? Do they even each other out? Like, do they just equal each other out, or how does that work?
I've never worried about it too much. I would say it's whatever your preference is as a business owner. It doesn't make any difference tax wise. So if you wanted to consider it to be zero, I would be fine with that. If you wanted to see both, I would be fine with that as well.
You just tell your accountant, like,
Yep, I would say whatever you feel like there. I probably would show it as a contribution and a distribution, but that's just me.
great. So one question I had, just kind of now that we've talked through each of these line items, is like, this number to me as a simple jam farmer who's just trying to live from day to day, who has $1,500 in her bank account, like looking at these giant numbers,
Mhm.
I'm seeing $1,500, but the number at the bottom says $353,000. How does this help me like on a daily basis? Or again, like now that we've walked through all of this, my day-to-day life, I think, is just thinking about my bank balance, but why is it important to keep these things in mind and like to see this as the whole picture?
I think it's important to see it as the whole picture because once again, it represents a snapshot of your overall quality, your company health. If you look at your balance sheet and you see you have current assets of $1,500 and current liabilities of $100,000, you have a lot of worrying to do. So seeing that how your current assets play against each other, seeing your debt to your equity can be important for obtaining additional loans, things like that. So it's how bankers use it. It's how you should use it as a business owner.
Thank you. Let's talk about common errors that you see.
Sure. So some things that make reviewing the financials maybe a little bit harder than they have to be is the first one would be capitalizing small items that you can just expense. So Catherine's a jam connoisseur now. She started her business. She buys a wooden spoon for $8. It's a fancy wooden spoon. She knows she'll use it forever. So she capitalizes it and she writes it off over the course of 7 years.
And what does capitalize it mean again?
It means you put it as a fixed asset rather than an expense. That is unnecessary. You're going to buy lots of small pieces of usable tools over the course of time. You don't need to capitalize everything just because you know you're going to use it more than a year. Save capitalization for larger items.
So it's more about the cost of the item and less about the usability of the item.
Correct.
Excellent.
Another common thing that I see with books that are not in good shape is negative balance sheet accounts. So if you see that your cash is negative $600,000, your accounts receivable are $1.8 billion, and that your current liabilities are negative $883, it's very unlikely those financials are correct. You should see positive information in each section. There's things that can be negative, accumulated depreciation being one of them. You see the little brackets around there. It's not shown, it's shown at zero, but the first accumulated depreciation number will be negative. You can accidentally pay a credit card twice. It happens to people. So that would be shown as a negative balance as of, whatever date you paid it, but it's uncommon. It should be the exception, not the standard.
Definitely. So in general, I'm looking at this. When depreciation hits the balance sheet, like that could be a negative number. But in general, we are really looking for positive numbers across the board. No matter how much money you owe someone, it should really still be showing up as a positive number.
That's right.
Okay.
The other item that's oftentimes incorrect is inventory. So inventory systems are often separate and not accounted for in the actual books. So it's not uncommon for me to see an inventory number remain the same year after year after year. The only time it gets updated is if you either integrate your inventory tracking system, which is out there and exists with most accounting softwares. Having that integrated will make it more likely that the inventory level is correct. The only other option is if you perform a physical count, which regardless of if you have an inventory tracking system or not, I do recommend you perform a physical count as close to the end of the year as possible so that you can ensure that your inventory tracking system is aligned with the reality of what's happening. Inventory tracking system can say that Catherine has 8,000 jars of jam if something's entered incorrectly. In reality, she only has 12. And if she's just going off the tracking system, she may go, oh boy, I don't have enough to fill the first order of the year.
This is honestly something that I've never understood why accountants cared about, to be perfectly honest. I've always kind of been like, it's on a shelf in your warehouse. Why do you care? And it is like kind of looking at the balance sheet now and understanding a little bit more. I now see why you care. It's literally a number that's on here. So if it's incorrect, your financials are incorrect. It's not just like you've miscounted the jams in your cellar.
Exactly.
Makes a lot of sense. A light bulb moment for me, if you will.
Great. Aged receivables. I think that we've kind of covered those a little bit, but let's go over it one more time. It can illustrate the balances that each customer owes to you and how old those balances are. So it can show that if Kuhlengel Farms is always paying in the 0 to 30-day section, that they are a good client. And if Kruse Cookies, who is buying your jams, is always 90 days past due, they may not be a great business customer. Maybe they pay eventually and you're willing to deal with that, but at least you're aware of it rather than finding out way down the line for some other reason.
It's very helpful.
Yep. Aged payables can let you know how the quality that you are as a customer, or also more likely what bills you have coming down the pipeline and whether or not you'll have the cash to cover them. So if you have payables that are due within 15 days rather than 90 days, you know that you'll need to have cash more immediately versus later down the line.
Great. What are common errors that you see there?
Common errors that I see with accounts receivable and accounts payable are recording a payment without ever having recorded the receivable itself. Very common. Once again, that's going to lead to negative accounts receivable. Whenever we see negative accounts receivable, it's an indicator that something's incorrect with the financial statements. Could lead to paying taxes unnecessarily. So want to make sure that you're paying attention to that.
So again, and regardless if you owe someone money, you should really have positive numbers on your balance sheet.
Yes, there can be exceptions. Once again, if you issue a credit on someone's account and that credit is taking place over a period of time, multiple orders have to be put in order to get it back to 0. It is possible, but it is the exception, not the standard.
Excellent.
How can we help you? We can help you build your balance sheet. Blueprinting your balance sheet can provide you with a standard that is user-friendly, allows you to look at reports. Highly recommend this. Getting something set up to where it's actually workable is great. I've seen balance sheets that cover 3 pages. There is no one in the world, including me, who's going to be able to look at that easily. And I look at balance sheets every single day.
I think the nice thing about blueprinting, which is what we at Hot Cruisy basically call a custom anything that you want. I think the nice thing about blueprinting too is that we're going to walk you through a series of questions to find out what matters to you, to make sure that the balance sheet is reflective of that, but you're also going to get a balance sheet that makes sense to us as an accounting firm as well. So you get the best of both worlds.
Yep. We can also help you review your financials after you've operated. So let's say Catherine maybe didn't have the funds available to pay us at first, and she wanted to take the first crack at her financials. She could always have us come in after the fact to look over them, to tell her whether or not she was doing them correctly, incorrectly. Absolutely something we do for clients, something we'd be happy to do for you.
Excellent. Great. Next week.
All right. So that's the end of this week's session. Next week, we will be going over the income statement, some different financial statement of cash flows, how you can customize your reports, and what is accrual versus cash basis accounting. The question everyone is asking themselves right now, I'm sure. After that, we'll be going over sample charts of accounts, talking about what you can deduct. What does deducting something actually mean? I think everyone has seen that episode of, what was it, Seinfeld? Oh, it was. Well, you haven't, I guess. And then also how you can categorize your expenses.
Excellent. Really looking forward to that. In the meantime, if you have any questions or if you'd like that YouTube link to watch this webinar again, please don't hesitate to contact us and we will look forward to talking with you next week. Thank you.